After 6 very quiet years for economic policy making, they chose a good 6 years to do it, and after 15 years as the director of the National Institute before that, covering lots of big areas and building that institution up into a force in British public debate. Now, in general, valedictory speeches are a good chance to look backwards at a period of policy making, to draw some lessons on that, to reflect in a calm way about what we've seen happen over that period. This isn't one of those valedictory speeches, because you might have noticed some things have changed in the last few weeks. Firstly, because whatever you think about Brexit, the one thing it has definitely done is increase the level of uncertainty in almost every single respect, not just as we were discussing this morning at Sushil about property prices, but in almost every area of economic life. And second, because over the last 2 weeks, it's become very clear that the August meeting of the Monetary Policy Committee, which will be Martin's last meeting, is not only going to have to wrestle with coming to a consensus view on forecasts for what Brexit means for the British economy, it's going to have to come to a consensus of some form about what it does about it. And those are two big issues that don't allow a lot of backward-looking reflection, but allow some forward-looking thinking and doing. And the good news is that if you believe in any form of learning curve or learning function, Martin's had 6 full years on the MPC, so he's at peak central banker performance. If that's your view of how policy making works, so that's the good news. Martin will give us his take on that and across 6 months. Then we have a panel to give their responses initially to that speech. We have Sushil Vivani, who was a similar alumni of the illustrious MPC from 1999 to 2002. At that point, dot-com bubbles were about as bad as it got, and we thought we'd abolished boom and bust. So those were the good days. We are now definitely not in those times. Melanie Baker from Morgan Stanley, UK economist, with a background in currency economics, which will hopefully come in handy for some of the questions later. And all of you probably know Chris Giles from the FT, where most of the British elite gets what they vaguely know about economics from when they get through the first 5 paragraphs of Chris's piece every day. So that's our task today. We'll then have lots of time for your questions. The deal will be, we'll keep the answers to your questions brief and make sure you get answers if you ask very brief questions. So, without further ado, Martin, I'd like to come up and kick off.
Well, thank you very much, and many thanks to all of you for coming here today. Perhaps I could start by, dare I say, correcting one of the introductory comments. The Monetary Policy Committee doesn't work through consensus. It works through individual members voting individually and being individually accountable for their decisions. And that is in some sense a thread that will run through today's discussion. Well, as you might have imagined, when I arranged this talk, I was thinking, just as Torsten said, about looking back, what lessons I'd learnt, and a script had to be discarded. Because obviously no one was very interested in the first 5 years and 11 months of my time on the committee. I should also say that while my last duty as a member of the committee is in August to vote at the August round is going to be based on the August forecast, while we have done some preliminary work for the inflation report. That, not surprisingly, is not yet complete, and I don't want to fall into the trap of forecasting the forecast. So I'm going to set out some of the issues and some of the various tensions that I think monetary policy faces at the moment. One of the problems the committee has is that there are very few data. Financial markets have been fluctuating fairly widely. There are always questions, at least that I have, about what you might hope to learn from financial markets. Should we be think that the movements in financial markets carry implications for what I call the real economy, that they matter for the variables that matter to the MPC, unemployment, inflation and output, or are they just people trying to get their bearings? Well, the first chart here on the left-hand side shows the movement in the exchange rate. And I've deliberately shown this back to 1975, the beginning of the data series. You can see a gradual drift down in the 1980s, that was the period of rapid inflation, then a more stable period since, dare I say, since about inflation targeting started, but between 97 and the beginning of the financial crisis, the exchange rate was appreciably higher than it has been more recently. It was recovering from the floor in 2013, but we had a sharp drop after the vote. There have been some fluctuations. In particular, markets seemed quite pleased that we had a new government last week, and so some of the losses were recouped. When I put the slides together, the exchange rate was nevertheless down about 8% on where it had been before the vote, and an appreciably larger fall relative to where the committee had thought it would be if Remain had won. So the exchange rate is materially lower than expectations, and we're used to the exchange rate feeding through to inflation and so on. So is that something the committee should take into account, or should we be looking through the exchange rate movement? The right-hand chart shows market expectations of what the Monetary Policy Committee is going to do. These data are inferred from the market structure of yields at different maturities. You can infer from those where people expect the interest rate to be, and you can see that on the solid line, when we produced the May inflation report, there was some expectation of a reduction. Obviously, the committee doesn't do things like reduce from 0.48 to 0.42. Those are averages of market expectations. There was some suggestion of an early reduction. I must say, not something I saw the case for, but since the vote, the expected rate fell very sharply. On Thursday morning last week, I heard on the radio that the bank was expected to reduce bank rate. No, it was expected to be announced on Thursday. Well, that of course didn't happen, but I think later on the position of the curve hasn't really changed very much. So the market is expecting a sharp fall in interest rates, not to negative levels, but certainly to levels appreciably lower than we have ever had in the past. What about other information from securities prices? Well, a key issue for the Bank of England, for the Monetary Policy Committee, is the costs at which banks can fund their borrowing. Before the crisis, those were glued very closely to bank rate. You didn't really have to worry about the margin. Since the crisis, people have realised that banks aren't perhaps quite as safe as they had thought they were, and so people now demand a risk premium for lending to banks. If that risk premium starts to rise, it gets passed through to borrowing costs in the market at large, because of course building societies, banks have to charge an interest rate which reflects the cost of the money that they borrow rather than the bank rate that the MPC fixes. So if that drifts up, that in itself can become an argument for a lower bank rate. I mean, what matters to people are the interest rates that they actually pay rather than the bank rate that the MPC fixes. And you can see that there has been a bit of an upward drift on the 5-year senior unsecured spread. Those are borrowing costs for banks on debt that isn't secured on anything but is quite highly ranked in the pecking order should banks have to shut up shop. On the other hand, the covered bond spread hasn't risen, well, it's risen slightly, but the movement in the red line I think is more marked. And certainly, if I were staying on the committee, I would be looking at how that seems to be feeding through to borrowing costs in the market, because, as I say, an increase in that red line can serve to generate a tightening of monetary conditions, even if the MPC doesn't actually change policy itself. Well, what about expected interest rates further ahead? I showed you on the earlier slide the short-term expectation of interest rate movement. Here on the right-hand graph, I'm showing the 10-year bond rate, and this is a sort of 10-year average of expected future bank rates. It's not exactly that, there are good reasons why it can diverge, but in the short-term movements are probably quite a good indication to what people are expecting about bank rate over the next 10 years. And you can see that it was rising sharply just before the referendum there. That was when markets had decided that Remain was going to win. It was not clear to me on what basis they'd made that decision. Indeed, in only 8 years' time, when the transcripts are released, you'll be able to see I said at the June meeting that I thought markets were excessively sensitive to movements in the opinion polls. But anyway, people had decided that Remain was going to win. We then had the result of the vote and a sharp fall in the rate, and you can see that it has been drifting down since, only really stabilising last week, though, as the political situation started to be a bit clearer. There were also downward movements in the yield on German bonds, shown here. Yes, it is negative. If you want to lend money to the Federal Republic for 10 years, they charge you for looking after it. And in the United States interest rate, their rates have picked up somewhat, partly because the latest indicators suggested that the economy was stronger than some people had thought. So, what you can also see is that there was more of a downward movement in the United Kingdom than in the other two countries, but at least for the first 10 days, 12 days after the referendum, there was an expectation that interest rates as a consequence would be lower for a long time, not only here but elsewhere in the world. It's possible also that the yield in the UK has been depressed by expectations that the Bank of England is going to restart asset purchases. I think some people were expecting that in July, when of course we didn't make any change to monetary policy, and there probably is an expectation that that is going to happen. But anyway, these movements in financial markets, the exchange rate is very important for what it tells us about inflation. There is evidence that yields are expected to stay low. What about the stock market? This chart here shown on the left-hand side, rather a busy chart, it shows their share prices in the United States converted to sterling. Those are share prices in Germany converted to sterling. That's the FTSE 100 index, and then quite a lot lower is the FTSE 250 index. Well, of course, the fact that the exchange rate fell sharply meant United States shares in sterling became more valuable. We had quite a sharp increase in the sterling value of United States shares. That, after a wobble, was also happening in Germany, but it was also happening to the FTSE 100 index. And an important factor behind that is that a lot of the FTSE 100 companies are international companies. They happen to be based in Britain, but they're trading internationally, so a fall in the exchange rate can push up their share price. It pushes up the sterling value of expected future profits. The FTSE index, the 250 index, those are companies which are much more tuned to UK conditions, fell fairly sharply. With ups and downs, it's been recovering since then, and I think if you were to look at the fall compared with the time of the referendum, it's now about 3%. And quite honestly, it's a bit difficult to get terribly exercised about that. When people talk about movements in stock markets, quite a good antidote is to say sometimes share prices go up and sometimes they go down. But no, if I did want to read the tea leaves of the stock market, and as I say, I'm not sure how useful that is, if I did want to read the tea leaves of the stock market, I would say that investors were expecting the economy to be a bit weaker as a consequence of Brexit than they had expected beforehand. But you certainly couldn't say that that's a strong signal. Anyway, so that's the news in financial markets. What about the evidence of what people are actually going to do? Well, soon after the vote, we had a couple of 10 days, 12 days after the vote, we had a measure of consumer confidence produced by GfK. They produce a regular monthly consumer confidence index to which people pay quite a lot of attention. Well, here what I've done is plot it against actual movement in consumption. The red line is the index. The blue bars are movement in actual household spending, growth over the previous quarter. The red blob right at the end is where the consumer confidence index ended up after the vote, and you can see there was a very sharp fall. People commented that no, it was the sharpest fall for a very long time or ever. But I think the key point that comes from looking at this graph is that I can't actually say, looking at that I'm confident that consumer spending is actually going to be weaker. And I would make a separate point. This survey was done from the end of June to the 5th of July. I suspect quite a lot of people who were feeling rather nervous about the outcome. I mean, many people will still be worried. They won't know what the trading arrangements are going to be, but they will feel less nervous with the appointment of a new Prime Minister and the establishment of a new government. In some sense, a vacuum that was alarming people has been filled. So whether we think consumer spending is going to fall markedly as a result of the uncertainty surrounding the vote, I think is really in the eye of the beholder. The Institute of Directors carried out a survey of investment intentions and recruitment intentions, and they found that quite a high proportion of respondents were talking about slightly decreasing or significantly decreasing their investment. Quite a lot of firms also said that they would recruit at a lower pace or that they would freeze recruitment, and this might suggest that the economy is going to slow down in the second half of the year, but again, it's difficult to say by how much. And I would make the same point as before. This survey was conducted immediately after the vote. Now we've got a government and a greater sense of organisation. Maybe people would see things differently. So I suppose the conclusion that I would come to from these indicators is that they do point to some weakening in the second half of this year, but it's difficult to say by how much. And there has to be a question whether these were sort of alarmed respondents immediately after the vote, and whether people would still see things like that after a longer period of reflection. Well, suppose output is expected to be weak. How might the Monetary Policy Committee think of responding? The traditional view is to talk in terms of a Taylor rule, that you set the interest rate with reference to output and inflation. And the rule of thumb is that for each 1 point movement in output relative to trend, you change the interest rate by half a percentage point. For each 1 point movement in inflation, you change the interest rate by 1.5 percentage points. Now here what I've shown are the outcome of 3 rules. The first rule shows what our model says would have happened if we had followed a rule that gave a weight of 1 to output, so already twice as much as is conventional, twice as important as standard, and then the economy would have followed the dashed black line. So if you look there, you can see perhaps up here that CPI inflation would have been weaker, it would have recovered less, but we would have had an appreciably bigger slump in 2009 and the recovery would have taken longer. If I want to look at, to do better at accounting for what the MPC did, then the solid red line is the answer, at least for much of the period. That's a line where we give a weight of 2 to output movements, as opposed to the cautious central banker who gives a weight of 0.5. So it's really suggesting that over that period, for better or worse, the committee gave quite a lot of weight to movements in output relative to movements in inflation. Our target is for movements to keep inflation close to target, but we have to pay attention to movements in output. As the text of the rubric puts it, we have to deliver the inflation target, but subject to that to support the government's aims for growth and employment. And sorry, I've always taken that to mean the more growth and the more employment you can get, the better, subject to the to meeting the inflation target. So it looks over the past that we followed the solid red line and gave quite a lot of weight to output. Well, another way of looking at it is to see how the MPC traded off inflation against output in its forecasts. Each time we produce a forecast, we forecast 2 years ahead. You can see what we're forecasting for GDP relative to trend, and you can see what we're forecasting for inflation relative to target. So if you think that the MPC largely gets what it wants in 2 years' time, I know it doesn't turn out like that, stuff happens, but if you think that the MPC sets policy to bring the economy back to an even keel in 2 years, then this chart tells you something about our trade-off. And it's explained in the text that, again, this is largely consistent with the idea that we give quite a strong weight to output movements relative to inflation movements. So where does that get us for monetary policy in the short term? I should say that in the long term, I find quite persuasive the arguments that trading conditions are likely to worsen, and those will have some long-term impact on GDP, on the nation's income. The nation's income will be reduced as a direct result of those changes, but having read the various studies, my sense is that there's much more uncertainty surrounding each of them than was perhaps communicated by them, so I would find it very difficult to say how much, but my view is that there will be some long-term hit. Now, why should a long-term hit have implications for monetary policy in the short term? Well, if people can see that coming, then there's a perfectly good argument that they may cut their spending ahead of the long-term hit looming. And if that is the case, that provides a classic argument for easing monetary policy. But as I say, looking at the consumer confidence chart, we don't yet have a terribly strong signal about what consumers are actually going to do. So one of the issues that I'll be having to think about at the August meeting is do I think the case is strong enough to make an anticipatory movement in monetary policy, or do I think it would be better for my successors to wait and see what actually happens? Well, that's the effect of Brexit on demand, and I haven't been able to put that in a chart because I obviously don't know. But on top of that, we have the effects of the fall in the exchange rate. That's something that's real and has happened and is pushing up on inflation, and the experience of 2008 to 2012, I think, suggested that the impact on inflation was more marked and more durable than had been thought ahead of the last fall in the exchange rate. Anyway, what does our model say about a fall in the exchange rate? And I should stress, hardly needs saying, the Bank of England model is not the truth. It's nothing more than a guide to organising thought. The committee certainly don't think it. Oh dear. Sorry about that. I hope people can still see it. Anyway, people used to be able to lecture without slides. The Monetary Policy Committee certainly doesn't see the model as the truth. It's certainly not the case that there's a true model and a false model. This is no more than a guide to us in coming to our decisions. Anyway, in some sense the red stands out more clearly now. But the black line shows what would happen according to our model if we followed a rule which gives a lot of weight to output in the aftermath of an exchange rate fall. And here I've shown 10%. Well, I didn't know where we were going to end up on Thursday evening. You can see that inflation picks up, but not actually by very much. Sort of less than 0.2 percentage points. Now, that's because these simulations are done with active policy in place. The effect would be much bigger if you look to see what would happen without an expectation that the Monetary Policy Committee was going to adjust interest rates to bring inflation back to target. So in that sense, this is different from many of the simulations that we show, but it does tell us about what this output-sensitive rule would do. In the short term, we would have weakness in output because prices go up ahead of demand, and you could make a case for a small reduction in bank rate on the back of that. But in the longer term, an output gap develops and bank rate, the black line, needs to rise. Well, I've also shown a couple of lines here representing optimal policy. That's described in the paper for anyone who's interested. So this on its own suggests that one could accommodate a short-term reduction even before taking account of the possible effects of weakness in demand coming from people bringing forward the effects of reduced incomes on their consumption. But what sort of argument is there the other way? It's very important on the committee that we try and come to a balanced view. Well, the dog that hasn't really barked for the whole of my 6 years on the committee perhaps is close to not barking again. This chart shows two lines. The blue line is growth in private sector regular average weekly earnings, and that's growing fairly respectably now. But the red line shows what happens if you look at the change over the last 6 months. And again, although the indications aren't clear, because there have been periods where this has picked up in the past and then faded away again, this does suggest to me that at least before the referendum there was evidence of increased wage pressure, and certainly for economists of my age, we're used to thinking of wage price spirals, because certainly for the first 20 years of when I was taking an interest in policy, they really happened. We're used to thinking in terms of wage price spirals. I'm certainly not suggesting that that on its own would be a reason for tightening monetary policy, but it is perhaps a reason for thinking about whether it's sensible to rush into an easing of monetary policy. So what will I be doing when I turn up to vote for the last time on the 3rd of August? I'll be doing what I've done at the previous 72 meetings where I have voted. I'll be looking at the evidence that we have, and as I say, we haven't got all the evidence yet, and I'll be coming to a judgment as best I can about what I think the appropriate way to vote is, so as to deliver our mandate, which is to keep inflation close to target, taking due account of output movements and recognising any trade-offs. Thank you very much.
Thank you very much indeed, Martin. That has the benefit of being a very clear economics answer, which is that it turns out the world is very uncertain. We shall see where the uncertainty takes us, and we shall act accordingly as things develop. Now, as I said, we don't just have Martin today. We have the panel, who I introduced to you earlier, who are going to give their responses to that speech and their thoughts on the situation of monetary policy as we find ourselves today. Should kick us off?
Thank you. First, thank you very much for inviting me. It's a great privilege to be here. It's an especially great privilege to have to comment on anything Martin has done. I think essentially, if I think of a model external member, the name Martin Weale comes to mind, because I think he's been absolutely exemplary. He's been thoughtful, insightful, and independent. And that's what we want of our external members. So thank you, Martin, for your 6 years at the bank. I've also, watching from the outside, have been very glad that Martin's speeches have been thoroughly researched and have made extensive use of the external MPC unit at the bank. The external MPC unit was a hard-fought game at the time. It wasn't easily achieved. And I've sometimes been sad that not all external members have made proper use of that valuable research resource. And I sometimes fear that it's something that could get taken away at some future stage. But there's been no fear on that account in terms of Martin. He's made good use of that valuable resource. Now, in terms of commenting on what Martin has said today, I was certainly at a significant disadvantage because I've not seen a text. I still haven't seen a text of the speech. So all I know is what he's just said. So if I say anything that's unfair, Martin, please forgive me, because it'll just be my ignorance as usual. Now, I just wanted to pick out a few things in terms of what Martin just said. The first thing is, I think he's absolutely right to say that the signal from the markets is far from clear-cut, and there is quite a lot of noise. I would actually go further. I think you appear to come close to saying that the fact that the FTSE 250 had fallen so little, to some extent gave you comfort that we might not get a very bad outcome for output. I'm not sure I would draw any comfort from the behavior of the FTSE 250 so far. At an anecdotal level, I've been stunned at the number of people who bought that initial dip in the FTSE 250 because they somehow persuaded themselves that actually, even though we voted to leave, we were going to get a cracking good deal and that everything was going to be fine. And actually the real impact of us voting to leave on anything that was going on in the real world was going to be minimal. And for that reason, the FTSE 250 was a buying opportunity. To me, it's very much, these sort of classic 7 stages of grief. And I think they're very much in a denial phase at the moment in the markets when I look around. I mean, this happens time and time again in the markets. I felt exactly the same way in '07. You had massive denial, and I think you've got the same going on vis-a-vis the UK economy in the market. So I think in terms of interpreting anything from market reactions, one has to be careful. I think it's just too early. Now, the other point Martin made was that, and you showed interesting data on consumer confidence and how little, that initial survey had responded, but he also showed that the correlation with consumption growth is not very strong. Now, the thing I'd say about consumption behavior is that I think sometimes as economists we endow too much sophistication to our consumers in terms of what we assume about their decision-making process is much, much more sophisticated than I think what we actually observe. They're much less forward-looking than is embodied in some of our models. And in a world where many of our consumers are skeptical of anything that experts say, they don't really quite know what to make of all these predictions of what's going to go wrong. So it seems to me that the most likely scenario is that consumption will be affected quite adversely, but that impact, the main impact, will only come after employment has moved. And it seems to me that, while one can be uncertain about much of the literature surrounding the economic effects of Brexit, the one thing that I hold on to with great confidence is the stuff about investment intentions and hiring. I think in both those cases, there is a lot of evidence about the impact of uncertainty on those decisions. Martin is right that the IOD survey was very soon after the event, and in any case it doesn't tell us anything about quantitative magnitudes, but I think if you look at episode after episode, that's the one robust empirical regularity, that you're going to see a meaningful impact both on investment intentions and hiring intentions. And I think only after that materializes will consumers react. So again, I think it's premature to say that things are going to be sort of vaguely okay in that sphere. Now, of course, one can't deny and argue with Martin's sort of main conclusion, which is that it's appropriate to wait for more data. But I would say that as a committee member, it's always tempting to wait. There's always more data you're going to get. There's always some more research the team is going to do. And I think the temptation to wait should be strongly resisted. I think back to the time I was in the committee after the sad events, tragic events of September 11th, 2001, and we convened a special meeting, I think on the 18th of September. And there was a significant minority opinion which didn't want us to do anything. And the argument was the same that you've heard today, which is we're going to get more data later on. We've got no data at the moment, so we should do nothing. We haven't done any analysis, we haven't produced any new forecasts. But fortunately then, the majority prevailed, and we did cut rates. And the sort of subsequent monitoring evidence by the agent suggested that actually it was a good thing we cut rates that day, because it helped give economic agents out there some reassurance that the bank was there ready and willing to act, and that it helped stabilize confidence. Which is why I think it was a mistake that the bank passed last week. I think just a small 25-week cut would have made less sophisticated agents out there fully aware that the bank is around to buttress confidence. my last point, because I'm sure I've overrun in terms of time.
Just about, yeah.
I'm so sorry. So wage price spirals. The question I have for Martin on that is, of course, in your duration on the committee, we went through a period with very high headline inflation, in a more robust economy with less uncertainty. We didn't get a wage price spiral then. Why should we fear one now?
Very good, thank you very much. Melanie.
All right, so just a few comments from my perspective, I guess more of a kind of city economist perspective. Just to point out, many thanks to Martin again, I back many of the comments that Sushil made. Just from my perspective, part of my job is to kind of second guess policymakers rather than say what they kind of should do. And unfortunately, I was one of those that was forecasting a rate cut last week, so that wasn't the best start. But I don't think it would be too wrong. Policy easing probably isn't far away. So let me just touch on a few things. Context, Martin talked a lot about the economic context. The immediate issue for the economy here, in my view, in our view, is the sort of main channel of impact being uncertainty, being confidence, and the vote, in our view, kind of opened up potentially a kind of profound, prolonged period of uncertainty. Both political and economic. I think, as Martin pointed out, some of the political uncertainty, you could argue, is ameliorated a little bit, but economically, clearly we've got some key uncertainties that still remain. Look, we expect this uncertainty, like the comments from Sushil as well, to weigh significantly on in business investment in particular. And a lot's been talked about the consumer, will they, won't they react? Bear in mind, we've got another channel of impact for the consumer, which is via the currency. So we have seen a significant currency depreciation that we would expect to feed through into inflation, and that then to dampen consumer spending. And I'm not just being kind of gloomy for the sake of it. Okay, there's a conventional response. Again, as Sushil was commenting, when you have an increase in uncertainty, this is the kind of thing that you'd expect to happen. I thought I probably should begin, just to wait so you know where I'm coming from. And there are lots of forecasts out there in terms of economists doing the rounds, what it might mean for the economy. Just to put it out, what we think is that rather than grow 2.3% next year, the UK economy would grow more like 0.5%, which I think is broadly in the range of economists' forecasts. Look, lower GDP and therefore more spare capacity would normally be expected to weigh down inflation, but we've clearly had this currency depreciation as well. We haven't got the bank's forecast, but we've been revising up our inflation numbers rather than down, clearly. So the context, as has been pointed out, is kind of challenging for the MPC here. The shock has raised the path of inflation. Further, if the immediate issue is activity and jobs, and the main problem there is confidence and uncertainty, how the Bank of England responds, how the MPC responds, can have an impact on that. It can impact confidence and uncertainty. There is a sort of feedback loop there too. It could perhaps bolster confidence. It can ease a little bit of that uncertainty. It could help avert some of the worst outcomes. It also, in our view, gives an incentive for the Bank of England to respond sooner rather than later and to communicate clearly around that. So our central case is that that's what they do, and we get a 40 basis point rate cut next month rather than this month, which didn't quite turn out as I'd hoped. And a QE to follow as well. They may blend in with the interest rate cut, given the Bank of England, the MPC more broadly, have been talking about a package of measures. But just one quick one on QE, hand over to Chris. One of the great things about Martin has been some of his speeches have really kind of pushed against conventional wisdom, including, for example, on QE, where one of his most fascinating speeches last year was about the effectiveness of QE and going against conventional wisdom, that maybe the second round wasn't that effective. So I'm interested to hear if his views at all have changed on that. I think whatever you may think, the MPC think QE is effective, so we expect that to happen. But monetary policy clearly can't be everything. But as I said, we think the bank could do something to settle the nerves, as it were.
We would all like our nerves settled. Right, Chris, and then we'll go back to Martin for some reflections.
Thank you very much. I think it was almost exactly a quarter of a century ago, I was sat in a lecture hall listening to Martin Weale lecturing me on exchange rate overshooting. I wish I'd probably paid a little bit more attention because I could have then said whether he was consistent today with what he said a quarter of a century ago, but I didn't, so I can't. In terms of what Martin did say, he talked about the market moves, which he said were essentially mixed, if a little bit suggesting that growth and the economic performance would be worse. I think that maybe the best measure for what the world thinks about the UK is to look at the FTSE 250 in dollar terms rather than in sterling terms. And then I think you get a better sense of that the world itself doesn't think the UK's prospects are that great at the moment. They don't think they're necessarily terrible. We're not going to be disaster, but that I think is maybe the best measure, and that's down. Well, it was down 17% immediately after it's come back a bit, so it's probably down just over 10% now. If we look at the data, we've seen, Martin put up the GfK Consumer Confidence Survey, which is bad, but from a very high level. These data often can go in sort of waves. We might get a bounce back, but equally we might get a further fall. We're going to get two significant bits of data this week. The rest of the data, frankly, has been pretty mixed, if a little bit bad, so I entirely agree with Martin on that so far. The two big bits, one of which Martin knows about but didn't actually mention, is the Bank of England Agents Report that's coming out on Wednesday, I believe, which again is quite a good indicator of what, if you do a ring round of businesses all over the country, what they're saying, so I think that's rather important. And also on Friday we get a flash Purchasing Managers Index, which again I think will be quite a good sense of where business sees the economy. So those two things this week will give us a better picture than we've had so far. Because so far we've had a lot of data from retail footfall, John Lewis sales, e-commerce transactions, which have been down a little bit, but really not very much. And I think you can't conclude too much from that. Looking at where we are in terms of what the effect in the short term is going to be from the exchange rate move, well, clearly that's going to raise prices, and in some sense that just makes us poorer. And so we should expect growth to be slightly lower. That's what happened last time round. The effect through import prices making us poorer, that's what exchange rates do. On the supply side, if business investment does fall, that obviously has demand side implications. It also has supply side implications in the medium term. And on the demand side, uncertainty clearly might make people want to save more and companies want to save more, which is something the Bank of England can offset with monetary policy if it's effective. But there's also something I was slightly confused about in Martin's speech, which was that if people expect in the long term to be poorer because of Brexit, monetary policy can bring forward some spending from the future to try and smooth out that process. But if we are going to be poorer in the long term, we are going to be poorer in the long term. So that if you bring forward spending, you've still got to make that adjustment at some point. In terms of my job, in terms of news out of Martin's speech, it was slightly annoying because we like to be able to tally people off. So we've got Mark Carney, he's going to vote for a rate cut in August. But Jan Blair, who's going to vote for a rate cut, he wrote that essentially, he did in fact vote in July, and he wrote in the FT today that he would go further in August, and Andy Haldane made that perfectly clear on Friday last week. So we've got 3 out of 9 who definitely are going to vote for a loosening in August. Martin, I still think I'm not sure how he's going to vote after this speech. It's probably exactly how he wants it to be, but makes things more difficult for news purposes. But given that the minutes did say that most of the MPC were expecting to cut rates in August, I think we have 3 who've said they will, and there are probably a majority that will also vote for some form of loosening, maybe quite a large loosening, maybe rate cuts plus something else, because we're talking sort of in terms of a package, I think. Is it going to be powerful in terms of mitigating any downturn that we see from uncertainty or people being rather nervous about the long term? Well, we do know there's lags in monetary policy, long and variable lags. So the key effect of a monetary policy loosening is really on whether it makes people feel more confident in the short term, or paradoxically, whether it makes people think, oh, we really are in something much worse than we thought, and might have a counterproductive effect. So I think the communication around whatever the Bank of England does is really important, and I don't have very good advice because I think we're in it's a very volatile world where we don't really know how actions taken by central bankers or politicians are going to be received. So what I think, I'm going to make a prediction here that the bank will act, and will act quite strongly in August, like the Financial Policy Committee did in its July or end of June meeting. But a lot of this is not actually necessarily with the confidence that this will mitigate any prospective downturn. But it's more in the game of the Bank of England covering their own back. And I'm not saying this in a particularly rude way. I think it's entirely the appropriate thing the Bank of England should do. If we are in a volatile and difficult position, the last thing the central bank should have directed at it is accusations that it hasn't done enough, that if only it had acted more, then whatever bad things might happen wouldn't have happened. So it's very, very appropriate for the Bank of England to do that. For the FPC have already done this. They said they put on the table relaxed capital requirements. No one's really expecting banks to rush out to try and lend to people at the moment, but it means that it's much harder for anyone to say the Bank of England has been preventing banks from lending. So in the game of mitigation, I think the Bank of England is likely to do exactly the right thing, act pretty decisively in August, but don't necessarily expect it to be very effective.
That is the incredibly pessimistic end to that. Thank you, Chris. Right, we're just going to go back to Martin to reflect on that, and then we'll get your questions. I mean, one theme running through that is there's a consensus across the panel, and I think across most of the world, people are allowed to be called experts anymore, on that there is a medium-term supply hit coming of some magnitude, which you cover in your longer version of your remarks, what those magnitudes may or may not be. But there are questions and differences in interpretation about how big and how fast any short-term demand effect, either driven by that or driven by other aspects of what is going on in sterling and others, and what that means for short-term policy.
Well, yes, thanks to everyone for their comments. If I could just pick up on a couple of points. Sushil, I didn't mean to draw strong inferences from the movement in the FTSE index. I can't have been clear on that, I'm sorry. My views on QE, on the effectiveness of QE, certainly work I did, suggested, as Melanie said, that the second round had been as effective as the first round, both here and in the United States. More recent work that a former colleague of mine has suggested that in the euro area the effectiveness of their asset purchases has been much weaker than we found in the UK, and I mean that may be because of the different structure of the euro area economies, or it may be because that was done at a point where interest rates were much lower than they had been at the time of our previous interventions. Now, I can add that to the list of things we don't know, but it's possible that with very low interest rates, the impact of the policy is weakened. And in that case, you might think that if you think that, then you might think that it would be less effective now than it had been in the past. On the issue Chris raised about demand and supply, the sort of framework I had in mind is that say the growth rate of national income slows because of the structural effects that you described, then if consumers think ahead, and I take Sushil's point, I'm certainly not sure that they do think ahead. If consumers think ahead, then they will take account of the fact that their total lifetime spending is lower than it would have been, and their spending now is likely to fall below what current supply in the economy could still make possible. So in those circumstances, there may be an argument for, there is an argument for the MPC to try and smooth things out, to try and ensure that in the short term, demand is closer to supply, and of course thereby to keep inflation closer to its target. The issue of wages that Sushil raised, it's a perfectly fair comment. As I said, wages have been the dog that haven't quite barked during the whole of my tenure, but if I do look at the short-term growth, it comes and goes, perfectly true. If I do look at the short-term growth, it seems to me now that, at least over the last few months, that has been faster than is consistent with the inflation target in the long term.
Right, let's get your questions. There's some mics. Sue in the middle. And Rob. Stephen, do you want to take one of these questions here?
Hi, Sue Chan at the Telegraph. Dr. Weale, I know you said very clearly that you have not made your mind up of how you vote in the August meeting, but in the context of your comments made at Nottingham University in March on the possible negative consequences of negative interest rates, how close to zero could interest rates go, in your opinion, if stimulus was needed? And are you more in favour of perhaps quantitative easing or credit easing, as a possible other tool? In other words, which sort of stimulus option produces the least side effects?
Great, let's take another question.
H. Smith from the Recruitment and Employment Confederation. I would like to know what the panel thinks about this government sticking to a full employment policy, including moves towards self-employment and other types of work.
There's one just behind.
Hi there, Anna DeCosta from Reuters. I just wanted to ask, Carney had mentioned that you'll do measures that they didn't do in the previous crisis. And there's been some speculation this might include some kind of coordination with the Treasury about fiscal measures. Is there any consideration of sort of people's QE type measures? Thank you.
Great. Well, Martin, do you want to start with Sue's question? How close to zero can we go?
Yes, okay. How close to zero can we go? Well, the Monetary Policy Committee has said that it thinks there is room for reducing rates. Now, I said I haven't made up my mind as to how I'll vote. One of the things that the bank is doing at the moment is exploring exactly that question. And obviously, to the extent that some people have said they do think interest rates should be eased, but I hope we'll have answers to that fairly soon. But the point I would make is that we have to be very careful about not cutting interest rates in a way that actually tightens monetary policy rather than eases monetary policy. For example, in Switzerland, when, as I mentioned in March, when negative interest rates were introduced, mortgage rates went up and not down.
It's probably not what was intended. Then, do you want to touch on Anna's question, and then we'll come to the wider panel on the radical idea of coordinating explicitly with fiscal policy?
Okay, the issue of full employment. The committee is given the rubric to deliver the inflation target and subject that to support the government's targets for growth and employment. And I take that to mean subject to the inflation target, the more employment, the better. Now, one of the things that we have seen recently is the growth in self-employment. It's, I think, clear that at least for quite a lot of people, the sort of silver entrepreneurs, that some people are seeing this as an alternative to retirement rather than as an alternative to what we used to think of as more conventional work. I would expect that trend to continue, but obviously it's rather far removed from the monetary policy's job of delivering the inflation target.
And obviously on full employment, obviously since around the turn of the year, the level of employment growth is obviously now flattening out, so maybe the 74.2 or whatever we're at now is as close as we get to full. So should you want to come in on?
Is Martin going to comment on Carney and coordination?
Do you want to come to that?
Well, on the issue of people's QE, what I will say, as I said in March, that the people's QE, the idea of helicopter money and so on, I haven't been able to see in my mind the difference between those and fiscal action which the government could do combined with, say, quantitative easing. People have talked at length with things like helicopter money about the fact that it's irreversible. Well, Parliament can't make irreversible decisions and the Monetary Policy Committee can't make irreversible decisions. On the issue of people's QE, that I think really is a fiscal issue. If the government wants to fund increased spending of a particular type through particular bond issues, then that's entirely a fiscal issue and not a monetary issue. Our job is to set monetary policy in the light of those such decisions as the government makes.
Which one do you want me to do?
Well, why don't we touch on how close to zero can we go, which for Martin is a bit lower, and on people's QE/wider coordination, i.e. maybe just timing as opposed to something as explicitly coordinated as this.
I mean, on negative interest rates, I don't think the evidence is all in. I mean, certainly Martin is correct on Switzerland, and I think since that experience he could also talk knowledgeably about Japan, where I think the experience with negative interest rates is highly discouraging, although the BOJ refuses to accept that. So I'm not a great fan of negative rates. On the other hand, I don't share this pessimism that we're out of policy level, which sort of deeply takes me into the next bit. And I certainly would have been more open-minded than the current governor in terms of bad-mouthing helicopter money. I think if we get into a very deep recession, we may not call it helicopter money, but something which looks very much like it may in fact turn out to be essential.
Very good. Okay. Chris?
I think the time is quite good actually this time, and we're quite lucky in the timing because nothing's going to happen in government till the autumn statement, by which time we will have a much better idea how bad, not so bad, the short-term economic situation is. If it turns out to be quite bad, and the Bank of England has acted already in August or in September, then you could expect there could be some either explicit or implicit coordination between government and the central bank, not necessarily to do formal helicopter money, but to have a fiscal loosening at the same time as very loose monetary policy and perhaps more QE. So I think, if you look back at Lehman's episode, Lehman happened on about the 15th of September, and Alistair Darling cut VAT on about late November the same year. So that was pretty quick. The economy was already in recession actually since the start of 2008. Remember, none of this prevented the economy falling 6.2%. So the idea that it just solves every problem is living in cloud cuckoo land. But it can be effective and it can help to change sentiment. So if we are in a bad situation in November, I'd expect to see something like that happen.
And it is worth reflecting back on that phase actually, and on this phase, which is the formal action didn't come until a bit later, and similarly the formal action, I agree, probably almost certainly can't come until the middle of the autumn, but governments can give indications of their stance. You're already seeing a bit of that now.
Yeah, we knew the Labour
you knew what was coming, basically.
Was going to
I
do
think you may
something.
personally wish a piece about what was coming.
You might have had a tip-off of some sort.
Well, I couldn't possibly think about how that could have happened. Now, Melanie.
Yeah, in terms of how low things can go, I guess my job is to sort of second-guess policymakers. But it was, our best guess is more like 0.1%. It's very clear that the MPC generally they seem very uncomfortable with negative interest rates. In terms of the sort of helicopter money type option, we've said it's an option that must be on the table if things turn out to be significantly worse than expected. But yeah, I agree. It's essentially fiscal, but we think it's there as an option.
Right, let's get another round of questions. People? Do you have one right at the back? No, there we are.
Thank you. Philip Rush from The Mirror. So I was wondering, in terms of the delivery of effective stimulus, if it does indeed come to that at some later stage, and indeed extends eventually onto the quantitative easing side, whether you would look to exclude long-term government bond purchases to ease the pressure on pension fund deficits, and whether, perhaps related to that, you would consider broadening the pool of asset purchases. In particular, related actually to something I asked you about a few years ago, the purchase of Linkers. Thankfully, that was a few years ago rather than 25 years. So I can at least still remember the answer from that.
In 15 years' time, hopefully you'll still remember as well. Right, let's get one more. Tony's at the front here, shall we? There's a microphone coming to you. Stephen. You're on, Tony.
Birmingham. It strikes me that at this time, with monetary policy options somewhat constrained, given that there is a floor to interest rates and asset purchases are of uncertain and dubious impact, that it would be much better to err on the side of looser policy than to find yourself having later down the road having set policy too tight. And in that regard, one thing we can all agree on is that there's more uncertainty around, even if we can't necessarily agree on whether the prospects after Brexit are worse or not. And that itself, following a kind of Charles Evans-like logic, merits looser monetary policy without any need for revising down your expected level of demand. Can you comment on that, Martin?
Great, and so one more.
The Recruitment and Employment Confederation. In terms of the information that we need in order to make accurate forecasts about the economy, if employment levels are so important for GDP and consumer confidence, many other things, how important is it that we get clarity on the future of freedom of movement? When do you think we will get that, and when would you want to get it?
Great question. I'm not sure we know the answer. Right, so on this first question from Philip on the nature of any wider quantitative easing, what is up for purchase, you've set out your view on the more effective than many people thought second phase of QE, but what do you think about the more radical options about more private sector asset purchases? In fact, I think you were arguing for no government bond purchases.
Well, no, I mean, there are a number of issues. No, when the bank makes interventions in markets by buying government debt, for example, then we do have to think about whether they're going to be perverse consequences and structure them to avoid those as best we can. Consequences for demand of the effects on pension funds are one of the things that we have to think about. On the issue, I couldn't give any definitive answer on the issue of widening the scope to private sector assets. I would say what I said in Nottingham in March, that for 300 years the Bank of England was buying private sector assets. Now, admittedly, they weren't corporate bonds, they were bills of exchange, they're rather different, so we don't have a template from 1694 on how to do it. The point I want to make is that in the past, the fact that their private sector hasn't been an insuperable obstacle. On Tony Yates' point, yes, I agree there is more uncertainty around. One of the big difficulties we have in understanding the effects of uncertainty on the economy is how far these sorts of things are already taken into account in asset prices, in share prices, and so on, and what the consequences of this uncertainty therefore is. Because if it's all too easy to say we've got an uncertainty indicator, that's gone up, we therefore lock quite a lot, or lock something off growth, then we lock something else off because we think investment is weak because surveys are telling us it's going to be weak, then we lock something else off because the stock market has gone down, and of course all of those things may themselves be the consequence of what your uncertainty indicator is telling you. So you have to be very careful to, and it can't be done with any precision, but you have to be very careful to avoid any double counting in coming to a balanced view, and that's exactly the sort of reason why I'm glad to have another 2 weeks to think about it. On the issue of freedom of movement, well, it's a monetary policy committee, not a migration policy committee, so I'm afraid I couldn't say anything at all on that.
Just to make Tony's question more concrete, so last week, actually I don't think he said it, but in words added to Andy Havden's speech, he said, "I would rather run the risk of taking a sledgehammer to crack a nut than taking a miniature rock hammer to tunnel my way out of prison," which I believe is a popular culture reference to Shawshank Redemption, I'm told by those more in touch than that. Yeah, are you in favour of do you lean towards sledgehammers or miniature rock hammers?
Well, I suppose I lean towards doing what I've always done, which is trying to form a balanced view of the evidence. And, people talk about the risks of waiting, and the risks of waiting are certainly there, but on the other side, the assumption of responding too rapidly, perhaps giving misleading impressions of what you expect that to deliver, is also there. I certainly take the point Sushil made right at the beginning about how there's always a tendency to wait for more data, and one of the things I've learned on the MPC over 6 years is that you have to come to judgment. You're never as well informed as you would like to be because the data aren't there, and that is exactly the situation, or at least the situation that we're going to face in August is an extreme form of that, but the right way to come to a decision is by weighing up the evidence such as we have, and in particular starting to think whether some of the immediate responses might have reflected shock rather than a cooler view of the likely impact.
So your hammer is still in production, it sounds like. Sushil, you sound like you're a sledgehammer man.
I wouldn't use colourful language like that.
Did you not hear Chris's cries of pain earlier?
But I certainly think, in terms of broad logic, I think Chris was absolutely right. Essentially, given the lags between any policy action and the impact on the economy, and given that we start with inflation relatively low, I think the reward-risk ratio favours acting preemptively, and if you've done a little bit too much, it's easily reversed. I also completely agree with what Tony Yates said, and I think Martin is right in terms of saying that some of the impact of uncertainty is already impounded in asset prices, but the one point I'd make is not all the impact of uncertainty is impounded in asset prices. Certainly all the work we've done with these measures of uncertainty that Nick Bloom at Stanford produces is that there is often a surprising time lag between his measures and what asset prices do. And he's got a long time series for the US daily, and you can do a lot of statistical work with that. And there's certainly quite a lot of information in that particular time series which doesn't show up in the US financial markets for a while.
Chris, are you expecting round 3 of QE or rebooted QE buying different assets?
To be honest, I don't know. Is the honest answer. I wasn't going to answer that question. On Tony's question, I tend to agree with him that is the time where you might take a more risky, or you wouldn't worry too much about the risk of doing too much too soon. In terms of freedom of movement, I think it's going to take a long time, because we're going to presumably get some form of clarity about what the British government would like to achieve in the autumn, which will probably be being inside the single market with restrictions on freedom of movement and the EU paying us money for the privilege. Because we need to get the 350 million back. And the rebate. None of that's not possible. So what will be possible will take a long time to get a better sense of where the trade-offs are. This is where I think Sushil made exactly the right point earlier, that it's very, very early days yet to know how the public and Britain will respond to Brexit, because we're not in a position yet where the real trade-offs are in any way clear.
No?
Just to this freedom of movement point, it's getting clarity like this. Useful for economic forecasting, but particularly in the longer term, I think I'm trying to think about forecasting the next 18 months. You can probably roll it up into one of those sources of uncertainty that therefore affects investment and hiring decisions generally. I think for the impact on potential growth, What happens to immigration with the immigration controls, one of those things that we felt was going to be significant in terms of determining where potential growth went.
So we don't know. Exactly. No. Right, let's get one more round of questions and then we'll release you to your busy lives. There's a gentleman right in the middle.
Thank you. Josh Ryan Collins from the New Economics Foundation. Just had a question about house prices, land prices, which hasn't been discussed yet. The Bank of England released a very interesting piece of research last week, I think, showing that 75% of all SME lending is collateralised against land, commercial property. So a fall in land prices or house prices would appear to be fairly potentially catastrophic for the SME sector. And obviously there's quite strong evidence that QE doesn't necessarily help there, aside from the fact that it may, there's some evidence that it does raise asset prices. But on the other hand, we've got this huge affordability problem that Resolution Foundation have written about around house prices. So I just wondered if the panel could reflect on that sort of wondering.
Great. Dan?
Thanks, Dan Corrie from Untitled Chapter. We've recently had, we've got a brand new Chancellor, and we've had the old fiscal policy thrown out the window. So we really don't know what on earth is going on in fiscal policy. I'm interested that you haven't mentioned, none of you have mentioned that much. Is that because you don't really believe it's going to change, or because monetary policy shouldn't be affected by those sort of things?
Great question. And then there's a lady right here at the front, and then we'll...
When I last looked, there were 300,000 pages of regulations, which is about 5 times the size of my Encyclopedia Britannica. We also suffer this evil thing called VAT. Now, if this government has the guts it appears to have, and cuts down on one and abolishes the other, are you ready for the surge in investment and industrial drive that is just waiting on the brink for action?
Great. We've ended on a radical note. Abolish VAT and regulation and investment will surge. And that's the most optimistic I've ever heard anybody at a Resolution Foundation event. Right, now, Sushil, I thought given that we've started off with property prices, the question there, we're having I thought you might share your anecdote about property prices and what is currently going on in the commercial property market at least.
Yes, I mean, we'll certainly get on to my anecdote in 10 seconds. I mean, in terms of the, I think the point you make is exactly right. The potential impact on bank lending is very meaningful because so many of these loans are indeed collateralized on the property market. And I think to some extent there is still a little bit of complacency about how significant moves in commercial property prices could turn out to be. In terms of the anecdote, it's a rather embarrassing one for me because it shows me being an incredibly unsophisticated agent, which is why I made this plea to Martin to recognize the existence of people like us. But way back in November, I contracted to move offices, and we got a larger new office, at a particular rent, X pounds a square feet, and we got the 9th floor in this building, and at the time the 8th floor was available at the same rent. We moved in early May, having sort of spruced, sort of put in all the technology and so on in the office, and the 8th floor is now being offered at 0.8x per square foot. So it's already a 20% fall in the rent since we agreed to it. And it seems to me that this will only go further. These are meaningful moves and certainly shouldn't be underestimated. In terms of the fiscal policy question, I think that was an excellent question. I imagine, I'm not going to put words in Martin's mouth, but certainly when I was on the MPC, we were only allowed to make entirely conventional assumptions about fiscal policy. So essentially you assumed everything was unchanged until you were told otherwise the week before the budget.
Very good. Also, Dan, I liked I don't think anyone has described Philip Hammond as brand new and shiny for some time, so he'll be very happy. We'll pass that on to him when we do. Martin? house prices?
Well, thank you very much. Yes, I mean, with house prices, there is exactly the tension you've described. When house prices or land prices go up, some people gain and other people lose, and that has economic implications. We have seen that over several decades, and weakening in land prices is an issue for some people, not others. I mean, that said, I would remind you that most investment that most businesses do is financed out of retained profits. As far as we can tell, it's easy to overstate the importance that people give, except in give to the role that you can give to the role of bank credit. It is important in the property sector, but retained earnings are the main way of financing investment. On the issue of fiscal policy, well, as Sushil said, we take the government's fiscal policy as given. Were we to do anything else, it could easily turn into a view of what we thought they ought to do rather than what they actually do. And the monetary, an unelected body like the Monetary Policy Committee shouldn't be telling Parliament or the government how it thinks policy should change. On the issue of abolishing VAT, well, I suppose that would really raise the question, how should we pay for all this government spending to a much greater extent than people are worrying at the moment. As to the consequences of seeing VAT abolished, I must confess I haven't thought about that. On the question of regulation, I would mention something which is in the text, but I'm afraid I didn't have time to talk about. In the period immediately after the vote, financial markets continued to function. There was no financial panic, even though there were quite large fluctuations in prices of assets like the exchange rate, share prices and so on. Now, my view is that that was largely because of the regulation that the Bank of England has put in place since the previous financial crisis. The purpose of regulation is to stop businesses doing what they want to do. That's why they're regulated, and that's why they don't like it. But if you have doubts about the merits of regulation, then look at the last 3 weeks and think back to the sorts of things that were happening in 2008. And to my mind, it's a good thing that life has been rather different.
In principle, defensive regulation is a rare and welcome thing. Chris?
I won't add on house prices, only to say that I was talking to a non-executive director of a challenger bank just a couple of weeks ago, who said that the FPC's action was all very well, and of course they wouldn't change the loans they were advertising they were going to offer, particularly in the residential housing market. They were still going to say they would offer loans at 75% loan to value ratio and in London, but of course in actual fact when they got to underwriting standards they wouldn't touch those loans with a barge pole. So I think we need to wait, and it could be quite serious about where that credit supply could be squeezed more than we think, even though we don't see actual loans being pulled. In terms of fiscal policy, no, I think, Dan, I think we are quite likely to see some fiscal policy action. Clearly, if there is a slowdown, borrowing is going to rise, and it's going to be higher than we thought in the budget forecast. So if Melanie's forecast that growth in 2017 is roughly right, so if it's roughly 0.5%, not 2.5%, so if you lose 2 percentage points of GDP, let's leave aside whether this is permanent or temporary. That's about 40 billion quid of GDP, which in tax revenue terms will be just under 17 billion, which is very close to 350 million pounds a week, in fact. So the OBR forecasts in November are going to be very interesting on many grounds, particularly, and people won't have forgotten the referendum quite then. But in terms of what extra you do, I think that's a decision for November, and I think the government will decide how much it's going to do in the intervening months. Now, of course, if inflation rises because of sterling's fall, and particularly if there goes into some forms of domestic inflation, or the public sector need some of the stuff that they import, that actually makes the current public spending plans tighter, not looser. They actually have to loosen them just to keep them as austere as they were. So there is quite a lot of there are a lot of moving parts there. And in terms of VAT and regulations, well, we could get rid of all our regulations, I would say, particularly ones which relate to the EU. We could stop being conforming with single market rules, and we could stop mutually recognising each other's standards, in which case we would not be able to send any goods to the European market. They would get stopped at Calais, impounded, and they'd have to be tested in every single border it crossed. And to me, that wouldn't necessarily raise production or create a great spur in investment, but it would clog up the M20 because lorries would stop there.
I think he's net anti. Now, on the it's worth reflecting on this. So the issue about departmental spending being lower because of higher inflation, something that hasn't been commented in public debate, is actually obviously the government has a benefit freeze lasting the next 4 years, affecting all working age benefits, and with higher inflation, the squeeze on those incomes it will be significantly, almost double actually, in the short term what the intention was when the policy was announced in terms of the squeeze on the incomes at the bottom, roughly 30% of the population. And so that is definitely, those kind of issues are going to have to be wrestled with, because it's all well and good offering other forms of stimulus, but when your existing austerity turned out to be significantly more austere than you expected, both public spending and on welfare, you may need to think again. Melanie, is there anything you want to add?
No, I mean, just on the sort of fiscal policy side, I mean, I think it's just at the same point, really, it's just hard to gauge. It's clear we're not going to have that emergency budget. We are going to have to wait till the autumn. We're expecting some slippage against budget plans, some easier monetary fiscal policy. It's just hard to know in advance to what extent that is going to be the case. And as has been mentioned, I think the key forecasts we'll be waiting for now are the OBRs.
Very good. Now, because as I said at the beginning, this is a valedictory speech, we're going to have a slightly unusual thing, which is David Willetts. Could you just come up for a second?
Well, let me, on behalf of us at Resolution, really thank Martin for everything that he has done in public policy and economic policy over the years. As Torsten said, we're very privileged to have him giving this speech, looking back on 6 years serving on the MPC. It was so scrupulous and so balanced. It was a striking contrast with the referendum debate. And we are grateful for the rigour that Martin typically brought to the subject. But even before his 6 years on the MPC, he of course served for 15 years as the director of the National Institute. And that's where I first got to know Martin. And the National Institute did a fantastic job of opening up so many areas of public policy, including, as Martin was reminding me, including doing important work on fairness between the generations. And in fact, the Sharabang of Resolution Foundation now moves this morning from here to the Millbank Tower, where we're going to launch our intergenerational commission. So we're having a busy day. And thank you very much, Martin. Thank you to all of our panel, and thank you to you for coming along today.